Hello, my fellow investors. In this video, I'm doing my final analysis of DHC, and I'm going to break it down to a few segments. The first segment is going to be crunching the numbers and the current position of the company since more or less COVID had started. So what I did was I broke down each quarter, and I took certain data that I wanted to check out. So I didn't do by the 10Ks. I broke it down quarter by quarter. And what I did was I put in all the data per each quarter. So the rental income, what they get from the office portfolio, and the residence fee that they get from the shop portfolio, the total revenue, the total operating expenses, and the margins, the maintenance. So the maintenance is what they call the property operating expenses, and the maintenance margins. I calculated how much was the margin of the maintenance cost out of the total revenue. So they earned 266 million in revenue. The maintenance was 117, so the maintenance margins were 44%. And then the net revenue and the net revenue margins. Now, these numbers in this spreadsheet is totally different to what in the statements. And the reason for that is I did like a mixture of an income statement and a cash flow statement. So I wanted to know basically the income statement without depreciation, without other expenses or income. I wanted to know just the operating, what went in and out from the operation. So I'll give an example. Let's go here to the sorry. So this is for the, let's say, the second quarter of 2022. So I put in all the rental income and the residence services and total revenue. And so the property operating expenses, this is what I put in the spreadsheet as maintenance. So as a company writes in their reports, the property operating expenses includes wages, utilities, cleaning, anything that has to do with operating the asset. And so the total expenses, I took this number and I deducted the depreciation. So I don't care about the depreciation. That's not part of the operating income or expenses. So my total expenses will be so I'll include the general and administrative expenses, any other expenses, but I'll deduct the depreciation. And in the income, when I do the total revenue, the net revenue, I'll take the bottom line, but I'll deduct expenses or income that has nothing to do with the company's operations. So losses on equity securities. So in this quarter it was 10 million. So I don't care what the company gained or lost on a stocks they're holding from 5-star, whatever. I don't care about it. It's not part of the operation. So I always took the net income or loss. I deducted any income or loss from unrealized securities, and in this case also. So this happened one time throughout all those quarters, was loss on modification of extinguishment of debt. So it was 29 million. So also this is not part of the operation. It could be part of the operation. We could look at it, but this is a one time, more or less, is like kind of like a one time big expense that they had. That they paid the debt early, so they had a 30 million expense. So I'll deduct this. I want to get a clear picture of the company, how it's been operating since 2019, how much money they're getting from operations, how much money they're paying on expenses. That was the point. So I did quarter by quarter. So what I did was Q1, Q2, Q3, and Q4. So the problem with Q4, the company doesn't have 10Q for the fourth quarter. That's all in the 10K. So what I did was I went to the 10K and I took the numbers, the annual number for the whole year, and I deducted the first 3 quarters. So basically what I did was I wanted to know what happened only in Q4. That's how I did my all the data. So I'm not going to go in through this very. Whoever wants to see all the numbers could just stop the video and check everything out. So in the end of 2019, that's when DHC changed their management agreement with 5-star, and we see here the difference in the revenues in 2019 Q4 was 256 million, then it went up to 442, and also the maintenance, everything changed. So we really care about what happened since 2020, because that is when the change happened, and we need to try to figure out if the things are going to become better if things have changed for the better or for the worse since then. So in Q1 2020, they had a gross margin of 24%. So the total revenue is 442 million, and the operating gross margin was 105 million. That's 24%, and we're seeing that this number is going down quarter by quarter, more or less. So it's 24%. The next quarter, 17, 2%, 90%. Then we're going here to Q1 of 2021, 19, 17, 18, 15, 11, 13. So basically, the last quarter in Q2 is almost half of what it was a year and a half ago. 2.5 years ago in Q1 2020. Went down from 24% to 13%. And maybe even the bigger problem is the maintenance margin. So the way I calculated the maintenance margin, I took in the maintenance, what the company does, all the property operating expenses, deducting the depreciation, and I calculated how much was the margin out of the total revenue. So let's say in Q1 their maintenance was 360 million, and the total revenue is 442 million. So their maintenance margin was 72%. So 72% of the total revenue went to maintenance, and this number is also getting worse not every quarter, but more or less. 72%, 74, 80, 79, 79, 76, 79, 80, 81, 86, 85. So this is a little bit better. And the reason why I care very much about the maintenance margin is because there's a big question we have to ask ourselves. We know that the senior housing has been hit very hard because of COVID. And we have to ask ourselves a basic question. If all the regulations of COVID go away and the occupancy rate goes up, so now the occupancy rate in the senior housing is around 72, 73%, more or less. Somewhere in the range of 70%. If, let's say, the occupancy rate goes up in the next year or two to 90%, will the maintenance go up also with the occupancy rate, or the wages stay the same, utilities stay the same, the cleaning expenses stay the same, taxes stay the same? So maybe, if nothing changes, but only this part changes, that occupancy rate goes up and the maintenance stay the same thing, so that alone could make the company's margins become much better and become more efficient, and maybe they can start earning money. So this is a big thing to try to figure out and understand. And you can also see the net revenue. So the net revenue was the operating revenue. I deducted, as I said, unrealized gains or losses on securities. I deducted anything that hasn't nothing to do with operations. So Q1 2019, 7 million, they earned 27 million. These numbers are totally different than what it says in the statements. And from there on, they're basically losing every single month, every single quarter. And Q3 2019, 29 million, 51 million. In this quarter, they actually gained. That's interesting. It's like the first quarter after they changed their operations with 5 stars, so they gained, but that's it. And Q2, 38 million loss, 119, 35, 75, 30, 75, 94, 78, and 69. So there is some, maybe you could call a silver lining, is that although the margins are going down, the revenue is going down, it seems that the losses, maybe, I don't know. We can understand that a company is going through so much problems with COVID, and the whole change with the management, I'm sure a lot of things go sideways and it's hard to figure it out. We don't see like going down every single quarter, just getting worse and worse and worse and worse. So let's say in Q3 2020, they lost $119 million. And we're going almost 2 years later, they lost only $70 million. So I don't know. If we take into the average, it's getting worse. The average net revenue margins in 2019, I did the average for each quarter. So over here they gained 3%, 10%, minus 12, and minus 20. The average is around 4%. 4% loss for each quarter throughout the year. In 2020, so we have 4, minus 9, minus 30, 90. It's like an average of around 11% per quarter in the loss in the margins. And 2020, it just gets worse. The average is like 20% net revenue margin loss per quarter in the average of the entire year. And we have Q1 and Q2 from 2022, so it's minus 25 and minus 22. That is an average of 23.5. So it's even worse in 2021. So basically, looking only at the numbers, analyzing the numbers, it looks like everything's just becoming worse. But we do have to ask ourselves a question. If occupancy rate goes up and the maintenance stays more or less the same thing, then that alone, even without any change, that alone could turn the company, I don't know if you could say profitable, but at least they'll be losing less money. So over here, I just put in the the reason why I'm looking at this company. So as of Q2 2022, the net tangible assets is 6.1 billion. The total liabilities is 3.3 billion. So the shareholders' equity of the net tangible assets, in this case, they don't have any untangible assets. So it's 2.78 billion for the company. And the shares outstanding, I include all the diluted shares that they gave out. They gave 140,000 shares. So it's 239 million. So the book value right now is 1167. And the company is trading at about $1. So we're speaking about of a less than 10 cents to $1. So of course we have to figure out, is a company on its way to bankruptcy or not. So I'll conclude my first segment of this final analysis. The numbers don't look good. That's, and what I mean don't look, I mean to say is it's just getting worse. Year by year, it's just getting worse. The margins are getting worse. The revenue is getting worse. Everything looks like it's getting worse. So we need to continue to the second part. Okay, so we're going to part 2. Over here, I want to figure out the company's current debt position for the next 2.5 years. So this is the last thank you from the second quarter of 2022, and basically I tried to figure out all the interest the company has to pay in 2022, 2023, and 2024. So I took here all the annual interest expenses, and I tried to calculate everything that's going to be in 2022, 2023, and 2024. So these are all the company's their bonds and mortgage notes, and the company also has 700 million loan they have to pay also in 2024. And over here, the total interest expense per year is 29 million. And so all these numbers are they're roughly estimated, because if the interest goes up, so all the interest expenses will also go up. So I'll break it down what I have over here. So the company's total liabilities is 3.3 billion. Debt due until 2025 is 964 million. So that's all their mortgage notes that are due, their 700 million that's due, and their 250 million bond. So the interest they have to pay in 2022 is 86 million. So I estimated this by taking the total amount they have to pay in 2022, and I divided it in half, as this first half of the year is already over, assuming the company already paid the first part of the interest for the first half of the year. And so in 2023 they have 171 million, and in 2024 165. So all these numbers are estimated at the last evaluation of the interest rates. If the interest rate goes up, so everything could change. So this number was a little bit tricky for me to find out. The reason for that is the company has a bond that's due in maturity 2024, and they're paying semi-annually, and I tried to find out when is this mature. If it's in the beginning of 2024, so they're not going to be paying interest that year. And if they are, if it's due in the end of 24, so they have to pay interest, which is $11 million per annual. That's a big amount. So in the end, I found this information in this is the form of the company's bond from 2014. So over here it says, then there was still a Senior Housing Properties Trust. So over here it said that it's due on May 1, 2024. So I'm assuming if it's a maturity is middle of the year, so the company will have to pay half of the amount. So if the annual interest expense is $11 million, so, and it's due in middle of the year, so I'm assuming they're going to be paying around $6 million interest that year. So the numbers are like this. All these are rough estimations. Nothing is exact, and a lot of things could change. So basically we have like this. The company has to pay until 2025 964 million debt. All the debt that's maturing until 2025. Plus they have to pay in the next 2.5 years 86 million interest in 2022, 171, 165 in 2023 and 2024. Now, how much money is the company going to lose in its operations? So we can't know that. So I just made a roughly estimation. I took the last 6 quarters, how much money the company lost in its operations the last 6 quarters. I made an average per quarter, and I just multiplied it for the next 10 quarters. That's for 2 quarters of 2022, 4 quarters of 2023, and 2024. So I have no idea if this is right. It could be way high, it could be way low, I don't know. But just doing estimating by the past 6 quarters, what's going to be in the next 10 quarters, I just put in this number. Let's say everything is the same thing, the company's going to lose another 705 million. So the total money the company needs in the next 2.5 years to pay off its debt and its interest, and assuming it's going to be losing at the same rate it's losing now in its operations, the company needs a little bit more than $2 billion. Now, the company has right now, as of the last report, $868 million in cash, including restricted cash. Restricted cash is cash that they have. It's restricted. It's in escrow accounts and everything, but they can use it. The company said that they use it for different kind of things. So the net minus the company is going to be, assuming all these numbers are going to happen, the company is going to be in a minus of $1.2 billion. That's a big amount. But is it significant enough to say that the company is on the way to bankruptcy in the next 2.5 years? I don't know. The company could sell assets. The company can issue more debt. Maybe they'll be paying 10 or 50% interest. Maybe it's not worth it for them. But it's right now they have a tangible asset of $6 billion. And if in the next 2.5 years they're going to be losing another $1.2 billion, they're not. It seems to me pretty far-fetched to say the company is in a state of emergency and it could go bankrupt in the next 2.5 years. So of course it's all rough estimations. Nothing is accurate. We can't predict the future, but we have to get some factual base to try to predict the future, or at least have a educated estimation what can happen to the company in the next 2.5 years. So let me just conclude this segment. Is the company in a position that could go bankrupt in the next 2.5 years? Doesn't seem so. It will be pretty unlikely for such a thing to happen. The company can sell assets, it can issue more debt. It has a lot of options. At the current situation, the last year or 2 years, the company still has a lot of space before it will be in a state of emergency. So when you continue to the next segment. Okay, so let's get to part 3. And part 3 is the most important part, and it's very hard to do any analysis about it. So what's going on with the management? So we know that our RMR is managing DHC, and it's managing Aleris Life, which was once 5-star, which is managing a lot of the shops from DHC. So if you would know that RMR is a good management and they know what they're doing, and we could trust them to get out of this whole problems, that'll be great. But we don't know. So this is the most crucial and important piece of this whole thing, to try to figure out what's going to be in the future, and it's very, very hard to know. So I'm just pointing out one paragraph from the last annual report. Our management structure and agreements with RMR and our relationship with our related parties, including our managing trustees, RMR, Aleris Life, including 5-star and other affiliates with them, may create conflict of interest. So this is very, very important. We don't know, and it very possibly could be that RMR is willing to sacrifice a part of DHC to save Aleris Life. Maybe not. We don't know, but definitely with RMR. There's a big soup going on. RMR is doing this, doing that. It's very hard to tell, are they doing the right choices or the bad choices. Even if they're doing the right choices, maybe they're willing to sacrifice part of DHC to save Aleris Life. So one thing that I want to check in is what assets were they selling in the past years. So let's say if there's a trader who has a great stock that's going up and he has a bad stock that's going down, and he's selling the good stock to buy the bad stock, that's bad decision. He's going after his emotions. He wants us to doesn't want to lose money, so he doesn't want to sell the bad stock. And instead of that, he's selling the good stock so he can have more money to buy the bad stock. So over here, I want to check which assets they sold in the last year. So we have here the shop, which is basically their problematic part of the portfolio, is their senior living. So in Q4 in 2019, they had 244 properties. And we're going to now, Q2 of 2022, they have 234. So basically they sold 10 properties in the last year and a half, in their bad properties, they sold only 10, which is it's 5%. And let's say we're going to the medical offices. These are the better assets they have. They had 104, and now they have 81. So they sold 20% of the medical offices, and only 5% of the shop. And the office portfolio buildings, they had 140 of these buildings, and we're going now. They have 104. So they sold basically almost 40 buildings of the office portfolio. These are the ones that are making money. These are the good assets, and they're selling the good assets and keeping the bad assets. So is RMR doing this because they want to save Aleris Life and they wanted to sacrifice DHC? That will be a very easy conclusion to come to, but maybe not. Maybe RMR, they didn't have any options. They had to pay back the debt, and no one wanted to buy any senior communities in the middle of the corona. So they didn't have any options but to sell the good assets. So maybe they did the right decision. Maybe they did the wrong decision. I don't know, but it's hard to come to any conclusion without sitting down and meeting the management for hours upon hours and asking all the questions, figuring out all the options they had. Why did they do this? Why didn't they do that? So the most important, the crucial part is finding out, is the management good or bad? We have hardly any way to come to a conclusion besides sitting down and meeting with them, which is impossible for me. So let me just say, the most important part, it's very hard to analyze. So let me continue on to the next part. Okay, so let's get to the next part. I want to first conclude all the bad and mixed news we have about the company. So in the first part, we crunch all the numbers, and it looks bad. The company is losing money quarter by quarter, but it's not totally bad news because you don't see it's not sinking every quarter, becoming worse and worse and worse. So it's bad news, but not too bad. Debt, it's bad, but not too bad. Management, we said the track record doesn't look good. It looks bad, but we can't come to a fair conclusion if it's totally bad or not. And Aleris Life now had changed management. Maybe that's good news. Maybe that's bad news. Maybe a change in management will make a lot of ups and downs in the company, and it will be bad. Maybe it will be good. I don't know. So that's the mixed news. The bad news, it's good and bad. We don't know very much. And now I want to get to the good news. So in the first part, I was talking about the maintenance cost, and will it go up or will it go down if the company starts going back on track. So I want to read here a few paragraphs from the report. Residence fee and services. Residence fees and services are the revenue earned at our managed senior living communities. We recognize these revenues as services are provided and related fee are accrued. Resident fees and services increase primarily due to increase in occupancy and average monthly rate to both comparable and non-comparable properties. So the company here is saying that the residence fee is going up if the occupancy is going up. So that's one part. And then over here, property operating expenses. Property operating expenses consist of real estate taxes, utility expenses, insurance, salaries, and benefits costs of property level personnel, repairs and maintenance expenses, management fees, cleaning expenses, and other direct costs of operating these communities. Property operating expenses increase primarily due to increase in labor costs, variable costs resulting from high occupancy at certain of our properties, and increase to our insurance premiums for certain of our properties. So we know, and this is basic common sense, the higher the occupancy, then the more revenue would come in, and also there'll be higher property operating expenses. So over here we have the good news. So the occupancy. So over here we have pre-COVID. We'll see that the occupancy rates over here is the weighted average occupancy senior living communities. So we have 84%, 84%, 83%, 83, 83, 83. So it's basically around 80, 85% occupancy. And now after after Aleris changed, so we'll go here to shop. So over here we are at Q2 2019, 84%, 84%, 84%, 84, 78. Now here it's COVID hit the hardest. It's starting to go down. 75, 72, 69. The occupancy is going down. 70, and over here it's starting to go back up. So basically it hit lows at the first quarter of 2021, and from there it's going up 70%, 71%, 72%, 73%, 73.6. So the occupancy rate is going up quarter by quarter, and this is a very good sign because the revenue is going to go up. And a very crucial question is, how much will the operating expenses go up with the occupancy rate? We know it's going to go up. The question is how much. So actually, I did research on this thing. I have a friend who has a friend who owns senior houses, and I spoke to him. I told him I'm looking into this company. I'm thinking maybe investing in it, and I have a few questions. I asked him a few questions, and he told me one thing. There's no question the wages are going to go up. He said there's inflation, the wages are going to go up. He said that's a sure thing. Nothing question about that. So I asked him how much will the fees and the expenses go up, wages, everything, if the occupancy rate is going up. So he told me basically like this. He said it's very hard to know a lot of things in the future. A lot of things could change. And he said if you have a community that has a 50% occupancy and it's going to go up to 90%, he said, yeah, a lot of wages will go up. You have to get more employees, more nurses. Electricity will be higher. Everything will be higher. Imagine you have a community with 50 units, which are totally out. No one's cleaning them. There's no electricity over there. You don't need nurses. You don't need staff. He told me if you have a community which has a 90% occupancy and it goes up to 100%, he told me basically there wouldn't be any change in the expenses. The same nurses who are taking care of the 90% will be able to take care of the 100%. Electricity would be more or less the same thing. Cleaning more or less the same thing. So it's nothing is for sure, but he said more or less if it goes up at 10%, there wouldn't be a very big increase in the expenses. So this for me was very crucial. If he thinks that going up from 90 to 100% wouldn't be a big difference, so we could basically say that going up from 70 to 80% also wouldn't be a big difference. It's not exactly, but let's assume that an increase of 10% wouldn't change a lot of the expenses. So we can simply say if pre-COVID they had 83% occupancy and now they're at 73. So basically we want the company to go back to what was pre-COVID, 80%, 83%, 84%. So it seems to me, but what he told me, that if the company would increase its occupancy 10%, there wouldn't be a lot of increase in the expenses and the operating expenses. So this is good news for me. The second good news is that COVID is more or less over. And I asked him, are the regulations about to be over? He said it's just a matter of time before all the regulations and senior housing would be over. So this is also a good thing. People are retiring. They need senior housing. And if psychologically they're not afraid anymore to go to senior housing, then that's a good thing. And if the expenses aren't going up and old people are starting to go back to senior housing, that's all good news. And if there wouldn't be any regulations that's stopping or making the companies paying more expenses and paying more insurance or whatever it is, all these things, that's all good news. And there's another big thing which I think is also very good news. And basically this point is very, very crucial. Let's say the economy is in a recession, and let's say it's just going to get worse. So a company that sells all different kind of products, they're going to have a big decline in their sales and everything. But senior housing, DHC, we can't say it's recession proof. Nothing is totally good. Recessions are bad for everyone. But all their office properties, all their MOB portfolio, that's not going to change very much because of a recession. They're leasing out their buildings, their facilities for 7 years. The rent is be the same. So unless a company goes bankrupt and they kind of stop paying rent, so DHC is in a good position. Old people still need to retire. They still need to go to senior housing. To go into a company now and we're afraid of a recession, that's a good news. This company isn't going to be affected so much by a recession as the other company. So if there will be a depression, that's something else. But if we'll have even a big recession, and it will probably be, everyone will be paying, it will be expensive for everyone. Everyone would be losing money, but that's, for me, it's also good news. We're looking to buy into a company and we're afraid of the future. I think this is another good news. So let me just conclude this part. The bad news is they're losing money, but it's not going down drastically every single quarter. The debt is in a bad position, but not too bad. The management, they have a pretty bad track record, but okay, we can't say it like that. Basically, way off. The good news is the occupancy rate is going up, and from what I heard from a person who owns senior housing, a 10% increase wouldn't affect the expenses so much. Second good news is COVID is more or less over. Regulations are more or less going to be out of the window in a matter of time, and this company shouldn't be affected too much by a recession, even if it's a big recession. Unless it's a Great Depression, the company should be in a pretty good state, and it's not too worryable. Okay, so let's get on to the next part. Okay, so in this part, I want to try to figure out the worst case scenarios and the best case scenarios for the future. Now, Charlie Munger is famous for saying that every time he looks at buying a company, he thinks of what the worst thing that could happen that could ruin this investment. I like to think both ways. What's the worst thing that could happen? What's the best thing that could happen? And that's easier to try to figure out how big of a risk we're taking, how far-fetched is the benefit, how far-fetched is the risk. So I think the first and biggest risk we have to ask ourselves is what happens if RMR stops managing DHC. So basically, there's no employees, there's no one to run the company. So that's a very bad scenario. How likely is it? Pretty much unlikely. I mean, RMR is running everything for 20 plus years. They're invested in the company. There's no real reason to think RMR would decide to terminate their management with DHC. So that's a big risk. I think it's pretty far-fetched. No reason to fear of it. And for me, the biggest risk I see in buying this company, the stock, is actually what happens if the company issues more shares. So basically, the only reason I'm interested in looking into buying the stock is because it's trading for 10 cents to a dollar. Now, what happens if the company decides they want to raise more capital and they don't want to sell any more assets, they don't want to take in any more debt, so they decide to issue more shares and they dilute everything. So let's say they want to, now that the company is trading at about a dollar for a stock, they're issuing 700 million stocks and they want to raise $700 million. So basically, my 10 cents for a dollar became 10 cents for 10 cents. So for me, maybe for the company it isn't a big risk. They're willing to slaughter their shareholders to save the company. But to buy a stock and the company could just decide to issue more shares and dilute everything. So basically, the whole point of looking into buying this company is thrown out the window. So for me, this is the biggest risk factor in buying this company. Maybe they will decide to dilute the shares. And is there any way to know if the company is willing to do this? I don't know. So let me just how many shares do they have authorized? Okay, so right now the company has around 239 million shares, and they have 300 million shares authorized. So basically, right now they could sell another 40 million, another 60 million shares. That's not very significant. It is, but not so bad. If I see that the company is authorizing to more shares, for me that's a major red flag. If they take up the number from 300 million to 500 million, and basically they can sell another, they dilute the shares in half, for me that would be a major red flag. But how big is this risk? So let's think. If the company would decide to raise capital, the stock is trading at a dollar. If they're selling, let's say, issuing another 200 million shares, if they want to sell it now at the volume that the stock is trading, they'll basically be selling it for $0.50 a share. The stock price is going to go down. It will take them weeks or maybe months to sell 200 million shares. So basically, they have to dilute the shares in half, and maybe in 200 million shares, maybe they'll get out of that $100 million. Maybe, I don't know. Maybe a little bit more, maybe less. I don't know. The stock price is going to go down. It will take them weeks or months to sell all these shares unless they find an outside investor. But basically, if the company is doing this, they're hardly going to be able to raise any capital, and they're going to be slaughtering their shareholders for nothing. So it doesn't make sense the company would want to do this, and they don't need to do this so much. They could sell assets, they could issue more debt, they could even renew the debt. They have a lot of options. I don't see this as a risk factor so much, but if I see that the company is authorizing more shares to sell, that'll be a major red flag, and definitely not to go into the company if such a thing happens. So that's the worst case scenarios for me. The two worst case scenarios is that RMR is leaving the management and that the company is diluting the shares. A third thing is if there'll be a Great Depression in the economy. That could basically knock out everything. So that's, as I said in the previous part, a recession wouldn't be too bad for DHC. Depression, that would be catastrophic for everyone. Now, what's the good case scenarios? So some companies, when they get into big problems, they have to have a miracle to get out of it. For me, the way I'm looking at it, all I need is a DHC to go back to what it was before COVID. I'm not looking for the company to turn a product that no one wants to buy. I'm not looking for them to rent out a property no one wants to rent. All I want is go back to normal. Go back to pre-COVID. So they have here a problem with the management, besides the problem that they have with COVID. But I'm not asking for a miracle. All I want is just get back to normal. The company should get back to normalized management, occupancy going back up. So for me, this is a very good scenario. It's not like I'm looking for a miracle to happen. I'm basically, I want the company to go back where it was before COVID. Although they weren't earning so much money, the margins since 2012 was only like 15%. And so I needed to get up. Or if the company goes back to earning money, even if it's very small amount of money, so the 10 cents of the dollar that I'm buying would go back to $1, even if the company isn't earning a huge amount of money. So I'm not asking for a miracle. So for me, that's the good scenario. So basically, I'm concluding my final analysis. I broke down the current company's position and all the numbers, all the expenses. I broke down the debt situation, the management situation, the good news, the bad news, worst case scenarios, and best case scenarios. So in the next video, I'm going to conclude everything in a very short video and just try to tell the whole story in a few minutes. Thank you very much, and I hope you enjoyed this video.